Hello everybody, today I'm going to talk about a question I have been pondering a lot recently, and that is, could the price of a stock ever go negative? That is, to where you, the owner of a stock, would actually need to pay the buyer money in order to take the share from you. And as insane as this would have sounded 2 years ago, I believe this question is worth considering simply with how insane the last 1.5 years have been. And when I say insane, it really has been insanity in the markets as well as throughout society. So before I answer this question and examine past historical events of stocks going negative or not in value, I'll just jog your memory to put the current time in light, just as to how unique of a time we're living in right now. Let's go back to January of 2020. A new virus spreads rapidly across the world and was able to spread very rapidly from Wuhan, China, due to the massive amount of visitors who traveled there due to the Chinese New Year. Let's go forward to March of 2020 when the US stock market indices experienced the most volatile bear market in history, dropping roughly 35% in just 6 weeks. And go forward a month from there to April of 2020, roughly half of the world's population was under some form of lockdown. We'd never heard of lockdowns before, at least on this scale. That was definitely a first time in history as well. And then go forward just 20 days, April 20th, 2020, oil prices go negative for the first time in history. Monday, as financial fireworks collided with evaporating demand and scarce storage. The decline below zero means that sellers are effectively paying buyers to take the oil off their hands. By late Monday afternoon, New York time, the front month WTI contract was sitting at minus 38.45 per barrel, down an eye-watering 310% on the day. So this is insane just to see a negative commodity price, and this is kind of in light with which I'm trying to answer this question of could a stock price also go negative. And then let's go forward roughly 7 months from there to January of 2021, also continuing through now. Meme stocks begin to gain traction, and Wall Street Bets and other trading groups send some stocks such as GameStop, Nokia, AMC, and others through the roof due to massive institutional short interest. Valuations play no part in this, and this is still going on to some extent, but this is completely unprecedented as well, just to see the extent of how high these valuations have gone. So this is definitely not an exhaustive list of first-time, modern historical events, but I hope this goes to show the caution with which I am making this video, because if there's anything that the last 18 months have showed us, it is that the seemingly impossible or insanely unlikely possibilities can very well become realities. So in all likelihood, to answer the question, we will probably never see a negative stock price. And I say probably because just how unusual of times we are living in right now. But I do not want to say it is impossible, but rather very unlikely. However, I do think that there is enough leverage currently in the stock market to send stock prices down much further than the fair value of the stock. But first I need to differentiate between price and value. Now, many companies whose stocks are traded right now actually have negative value, but the underlying price of a stock can never go below zero. So in order to understand this, I need to differentiate between price and value. As Warren Buffett has stated, price is what you pay and value is what you get. So even though a stock such as Nikola or Lucid might be trading at a positive price right now, these companies actually have negative shareholder value. And the real reason for purchasing these stocks is in the anticipation of growing shareholder value in the future due to growth in the whatever industry they're in this case the EV industry. So when you hear the term of over or undervaluation, this is when an investor compares the value they are getting to the price that they are paying on a particular stock, and then comparing this multiple to other stocks in the industry and other stocks in other industries, as well as to past historical precedent, and then making a judgment on whether this particular stock is over or undervalued. However, I will now argue that it is very possible for the leverage which we have seen in the last year which has driven stock prices up massively, even though the underlying value has improved very marginally to work the other way during the next bear market. I'll first look at some of the leverage, which has been in favor of increasing the stock prices in the last year, even though the underlying value hasn't increased very much. Number one has to be the federal funds rate that were cut to nearly 0% on short-term bonds, and this has forced investors much further out along the risk curve. In other words, being willing to take a much higher risk just to earn the same reward. So in other words, average investors, whether they know it or not, have been forced out along the risk curve in order to find a decent rate of return. Because let's be real, we all know inflation is well above 0% right now. In fact, it is now approaching the inflation highs after the great financial crisis of 2008. So very few investors are going to sit on their money as it earns a negative real rate of return. Instead, their advisors or pension fund managers will allocate more of their retirement or savings into stocks. So the Federal Reserve has, in a way, been a large contributing factor for this extremely quick recovery in the stock market from the lows of the market back in March of 2020. So when another bear market does come, the Fed can cut rates again, but they would be cutting into negative territory. And the real question here is, would they really do that? I don't know. It's possible they've really avoided that in the past, so they might not even do that again. So the argument there is that they've essentially pushed investors as far as they can out along the risk curve already. Number two, a reason for why there's just been so much leverage building on itself in the last 18 months or so is just due to passive investing. And this is nothing new. It's definitely grown in the last 10 years since the great financial crisis, but this has just continued to outpace actively managed investing by a large degree since COVID hit. And I've definitely discussed the problems with passive investing before, but I will just mention them again here. I know that this is somewhat of a controversial topic, but I won't get into any of the controversy of it. I will just explain how the passive investing algorithm is very simple and can lead to very large mispricings in the market. Passive investing, when followed by a minority of investors, will have very little impact on the market. However, when you have a large number of investors or pension managers or whoever they are, simply putting their clients' money into the S&P 500, for example, without questioning what is included in the S&P 500, this can lead to many problems. For example, do you think that some people would care that Tesla, a stock which has more than 10x'd in the last 2 years on very little growth in earnings, is also included in the S&P 500? Well, it's not that any of these clients would choose to buy Tesla stock on its own, but now that it is included in all of the ETFs which track the S&P 500, everyone who purchases these ETFs is now purchasing shares of Tesla stock, even though they are for the most part unaware of this. Or take, for example, GameStop or AMC Theater stock. Did you also realize that both of these stocks are included in the Russell 2000 index fund, and therefore all of the ETFs that track the Russell 2000? Even though they have both gone parabolic in the last anywhere from 6 to 8 months, again, very few of the people purchasing this index fund would want to also own these stocks. But again, because of the extremely simple passive investing algorithm, which says to simply buy whatever is included in the index fund if money flows in, and to sell if money flows out, many of these people buying these stocks are completely unaware of it. So as you might imagine, passive investing at the scale at which it is done right now is definitely impacting the prices of the underlying stocks. So as we saw during the brief COVID crash, volatility was very high, and I definitely expect the next bear market to be even more volatile than that. So if anything, the COVID crash was probably a sort of precursor to what I think is likely going to happen in the not too distant future. So all of this being said, it is likely that the price of a stock never goes below zero, but kind of like how the valuations placed on GameStop or AMC or Tesla have not been justified on the side of overvaluation, I think that these same mechanisms it is very possible for them to send these valuations far lower than what would be a justified valuation. So all of this being said, I'm not trying to put any sort of fear out there or provide any sort of financial advice. I'm just trying to answer a question which I have been pondering recently. If you like this kind of content, I call this channel The Contrarian because I typically just take or I don't always take the non-consensus view, but I just look at the fundamentals and I ignore the sentiment out there. So all of that being said, if you liked this video, just consider subscribing, and I hope to see you again.